on to the next one. PROG Holdings, PRG. So this is a sort of like a buy-to-let business, I believe. So customer wants to buy something, doesn't have the credit or the cash right now. PROG buys the item from the store, leases it to the customer. The customer pays back weekly or monthly. If they finish all payments, they own the item. They've also got buy now, pay later. And apparently they've got a small tool that helps customer improve their credit as well. Straight from the off, 3.21% is held by insiders, which is not particularly high, but it's certainly better than DXC was, isn't it? There have been some insider purchases earlier on this year, around about the same price as what we are now, actually. I would say they're reasonably significant in size. You probably can't see it on there, so we'll just bring it up on here. 101,000, 435,000, 300,000. They're not small purchases. I quite like purchases around about that size. Anything above like 200, 300 grand is pretty good. So yeah, but obviously this was quite a while ago, and the stock price has not really been anywhere since. Well, I suppose it has. It increased again, and then we sort of come back down. There are problems with this sort of industry, though, isn't there? Especially with the climate is the way it is. The amount of people that are going to default. So their progressive leasing, which is this part up here, they'll buy it and then they lease it back to you, is 93.6% of their business. They other side of it is 2.9%. But this bit here is being spun out, treated as discontinued operations according to their strategies. So basically, almost all of their businesses in the US. Future risk, credit risk, serving higher risk near prime, subprime customers, obviously the inherent risk of default. Big retail partner struggle that could hit progressive leasing. The loss of important retail partners is a problem. That was from their own, recent commentary. Consumer demand for goods as well could be sensitive to macro conditions. Obviously, macro conditions are not very good. Buy now, pay later is a crowded space. Competitors could put pressure on margins. And they've got non-trivial gross debt. We could probably tell that as well if you look from here. 1 billion market cap, 1.42 billion in enterprise value. So, it is what it is. Their largest business segment has faced specific headwinds. One major retail partner went bankrupt, resulting in a material drop in gross merchandise volume for that segment, which worried investors about sustainability and stability of their core business. They've sold off, like I said, their credit card portfolio for 149 million in cash. They're going to try and double down on growth areas to try and combat this decline. Let's get on to the balance sheet. The balance sheet I thought was okay. 292 million, 300 million in cash, so reasonably good receivables. So this here, I believe, is the portions that they own and are leasing back. So the balance sheet isn't too bad. Total liabilities are less than total assets. Debt here 600 million though. If we have a look, they have got bonds up here, 3 of them, 2029s. They're around about par value. So, what's that, almost 3 years out now. 4 years out actually, I suppose, because it's towards the end. Debt markets are not particularly concerned about their ability to pay it, not currently anyway, with around about that close to par value for a business that is heavily reliant on people actually paying up and not bankrupting themselves and all that sort of thing. So currently have 292 million in cash, so have liquidity to likely have no worries about the debt. They also have 350 million revolver, where only 50 million is currently drawn. So at the time I wrote this, actually a couple of weeks ago, the bonds were trading at around 97, so it looks like they've actually gone up slightly in price. So like I said, there's market confidence in debt repayment ability. If we drag up here as well, return on capital is very good. Nice green. They're not quite blue, which is better again, bright green. But 32% simple free cash flow, return on capital, 26% EBIT return on capital. So pretty good from that point of view. Income statement, quarterly revs are slightly down, but revs are slightly up through Q3 2025. That's year on year, I believe. Interest and fees, loans are significantly up, helping 40 million year-on-year revenue growth. Provisions for write-off has only increased by 20k, meaning they're, like I said, they're either stupid, liars, or they don't see people missing payments. Note state actual write-offs may differ significantly from allowance. That's the only thing that I don't like here. Actual write-offs may differ significantly from the allowance. So that's why I believe I've put this in bold, because this next statement's worrying, I suppose the thing is there that people could miss their payments every single day, and they are writing a statement for a point in time. So by the time it comes out, obviously that could have worsened. And there's not a lot I suppose they can do about that from a reporting point of view. Accounts receivable that are past due don't get written off though for 120 days, so there could be a significant lag in the write-off to reporting. Receivable write-offs through Q3 have grown significantly, almost 20 million, but recoveries have only grown by 4 million. So I don't like that. Lease write-offs have also have 120 days before they're written off. There's been a 10 million increase in lease write-offs, but no increase in recoveries. So it's going the wrong way from that point of view. Both receivable and lease write-off provisions were not enough to cover the amounts that were actually written off. So not great. 33 million net income swing to the negative, almost exclusively due to income taxes. EBIT is actually 26 million up, so swings and roundabouts there. Non-cash tax benefit 53.6 million due to tax law impacts. This artificially lower tax expense prior year. That was a boost to net income. They've bought back 25% of shares since 2020, though 306 million left on the repurchase option would equate to around about a further 11 million share decrease. So we do like that. I do like seeing that. Anybody who's buying back shares to me is a shareholder-friendly company, and 30 million in the last 8 years. So for me that's pretty good. I like that. I like to see that. What else have we got on here? I put the wrong thing here. So looking at the cash flow statement, let's just drag it up here. Drag this one up over the top. Operating cash flows increased significantly, mainly by 25 million accounts receivable provision, a 50 million swing in taxes, and 100 million swing in additions to lease merchandising, meaning they spent 100 million less buying merchandise for new leases. This shows the business is actually slowing despite free cash flow increasing because of it. So we can actually see that here. So what we're looking at additions to lease merchandising. Where was that? There we go, down here. Additions to lease merchandising in the investing section. Yeah, so they're paying less for new leases. So basically, that's not good in this sort of business. Obviously, you think, oh, capex has dropped. That's pretty good, but not in the way that this type of business works. Additions to lease merchandising is one of the most important operating cash flow items for Prog Holdings because it's the nature of the business. It is supposed to be negative, and a large negative number usually means the company is growing originations. So the fact that it's decreased means that they are probably, going the wrong way on loan originations. don't think I've put anything for peer performance. I haven't. So the outlook below assumes difficult operating environment with soft demand for consumer durables, no material changes in the company's current decisioning posture. Progress stated they expect revenues of 2.4 billion. This is down 100 million, which aligns with 100 million less in originations, which we've just seen here. So if we put this into my net present value calculator, and we'll see what we came up with, just so you can see it. I use revenues around 2.25 billion, which is, you know, more than 100 million less, but I do like to be conservative, especially with a business like this, where we're going into times where people's ability to pay back is probably declining. It seems to be everywhere at the moment. So yeah, 2.25 billion. What else did I do? Let's have a look. I only use 6% of EBIT margin, a simple free cash flow margin, which brings both around to around 40% shy of the average, which is possibly too conservative. But like I said, you're going into tough times, and they are, as you can see by their lease merchandising additions to, they are starting to lose new business from that point of view. So that would give future free cash flow a share of around 270, 269, 270. For an 11 times multiple at the current price. So ChatGPT reckons that a reasonable multiple would be 10 to 15, but if for this line of business, but there's so few businesses that are floated, it's actually difficult to tell what an average would be. So on that, you know, on 270 for a 10 times multiple, 10 to 15 times multiple, probably going to go on the lower end of that, almost certainly going to go on the lower end of that, just because of the current economic climate. I was watching something the other day, I think Steve Eisman was talking about originations of things and all that are starting to decline, and delinquencies and all that are starting to go up. So I can't remember what sector he was on about, to be honest, but obviously if you're seeing that in other portions of the economy, you're going to be seeing it in this one as well. So it's a very similar type of business from that point of view. So yeah, you know, on the lower end, we are already fairly overvalued, I would guess. So, you know, market cap could increase by, you know, another 300 million by paying down a 600 million debt using the available cash and extra financing. So that's a 30% increase on where it is now. It's just not enough for me. It looks fairly valued. Would need to be a lot cheaper. What I have pointed out in my notes, just down here though, is that it's twice hit lows of around $16 a share in the last 5 years, and for me that would be buy territory. I mean, we're quite a way above that now. But if we have got some form, I don't even know if this is a decent channel, but if we've got some form of channel going around here, and we are on the downward swing of it, we could be coming into some sort of buy territory in the future, especially if, you know, they're appearing to be starting to slowly lose some business and economies are worsening and all that. So it is one that I will keep an eye on, but it's not one that I'm currently willing to buy at this price. Yeah, so Prog Holdings. Thanks very much for watching, and I will see you on the next one.